Sebastien Page, T. Rowe Price, head of global multi-asset and chief investment officer, joins us now right here on set. Sebastien, good to see you.
Likewise.
We have seen a rebalancing of equity market performance and arguably economic growth expectations around the world. So I assume you think this is something that's sustainable and it's not too late?
Is this the time now, Mike? Because it's been a value trap for quite a while.
Very long time.
And how do you know when a value trap is no longer a value trap? As you said, we're long international value stocks in particular. You need two things. You need the valuation spread, but that alone won't work. You also need some short-term momentum, and you need the short-term momentum to be supported by fundamentals. And I think we're at that stage. We're phasing in to the international value stocks off the back of, yes, attractive valuations, but also fiscal spending, in particular from Germany.
Right. That was something that jolted the market, jolted global bond yields higher, and I guess from China as well. So is your focus more on Europe in the international basket at this point?
Yeah, we like Europe. You know, the international value stock asset class is the best performing asset class year to date. It's up 13%, maybe neck and neck with gold. Maybe gold's a bit higher. So what's going on there? You have banks that are in better shape than they've been in a long time. Think, Mike, pre-global financial crisis, European banks were trading at twice their book value. Then you had the zero rate environment. And up until recently...
Negative rate environment even there. Yeah,
and that's not good for banks. And up until recently, they were below 1 times book value. And now they're peaking above 1x book value. So even though it's rallied, we think there's more room for it to rally further.
China, too. I mean, China's been actually a quietly good story as well. First shot up last September on all the stimulus, monetary stimulus. Now they're talking about stimulating the consumer there.
Yeah, we're more cautious on China. I would say we don't have a house view at T. Rowe Price, so we're kind of divided on China. Some are long, some are short. My view is that there are broader structural issues in China that are still unresolved. Just look at the size of wealth destruction in the property sector in China and compare that to the global financial crisis in the U.S., it's actually 2 or 3 times the size of that wealth destruction. So you have structural issues that remain unresolved. I go back to, yes, there's momentum. Yes, there's a valuation spread. But do you have the fundamentals behind it?
But they have the firepower to deal with it.
They do, but they haven't used it as much as, when we used to talk about big bazookas coming out of China. We haven't seen that, and I think they want more stable growth than huge stimulus.
Haven't heard you talk about tariffs yet. I just wonder when it comes to Europe. April 2nd's not far away. We don't know what things are going to look like, whether we're going to get 200% tariffs on various products coming from Europe. How big a concern is that for you?
I'm trying not to talk about tariff, but it's impossible, right? And I'm trying not to talk about the word uncertainty. Last week, I got to say, I never heard the word uncertainty as often in the financial media in my entire career. And of course, it's related to tariffs. But I got some data from State Street. They have AI data where they scan everything that's said in the media, in the mainstream media. And I asked them, how often was uncertainty mentioned last week? I don't know how often you mentioned it on your show. But they showed me a time series going back 10 years. Last week was the week where uncertainty was mentioned the most often in the media in their 10-year data sample. So when uncertainty is up, stock prices are down. I'm worried about tariff like everyone else, but we have to widen the view of what's going on with stimulus in Europe and with banks in better shape and with finally positive rates. And that makes me want to continue to add to non-U.S. stocks despite the tariff talks. Now, who knows? Maybe we'll get some deals out of the tariffs.
That all makes sense for sure as the fundamentals kind of follow the valuation gap, as you said, although the U.S. consumer is the single largest engine of global growth. If you viewed slightly higher tariffs as, you know what, we're going to make the rest of the world pay a little more of a toll to access the U.S. consumer, that's one thing. If the tariffs are so high and inflation goes high enough and all of a sudden it hurts business investment and the U.S. consumer starts to flail, then I guess everyone is maybe compromised. What is your view of the U.S. growth path at this point?
I'm worried, Mike, about the U.S. consumer. The last two prints, including the one yesterday on retail sales, were not good, below expectation. The one before was negative and revised to minus 1.2 month over month. So I am worried about the U.S. consumer, but I would not count the U.S. consumer out. Household borrowing relative to disposable income is 30% lower than it was before the global financial crisis, close to an all-time low. Unemployment at 4.1, yes, it's rising, but it's quite low. There is a lot of employment in the economy. The long-run average for unemployment, let's just remember, is 5.7%. And wages are growing at 4%. And if you look back 12-month, inflation's at 3%. So wages are growing faster than inflation. None of this is equally distributed.
Right.
And the low-wage consumer is in bad shape. But in aggregate, I would not count the U.S. consumer out.
So slow does not mean contraction for a while. Sebastien, thank you very much. Good to see you.